two investors with the exact same overall portfolio, but one of them saves thousands of dollars in taxes because of one key investment strategy. It's called asset location. Where you park your assets matters. Today, I'm going to show you some simple and practical advice that you can apply to your portfolio today by simply learning which assets belong in which tax bucket. I'm going to show you an example of a sample diversified portfolio with a few of my favorite index funds and ETFs. Now, depending on the type of investment you're holding, you can have 4 different types of tax treatments that we'll discuss today. We'll talk about tax inefficient assets and we'll talk about tax efficient assets. And in the end, I'll show you the optimal tax location or asset location of all of these different assets in the pre-tax bucket, in the Roth bucket, and in the taxable bucket. Hi, and welcome to the Money Matters MD show. My name is Dr. Abhishek Gadre. I'm a practicing physician and I help high-income professionals like you take control of your money. So you have a silent partner in your investments, and it's called the IRS. A well-diversified portfolio will have multiple different types of asset classes. The tax treatment of various different asset classes can vary widely. Now, it can be as high as more than 50% and can be as low as 0%. Now, let's break this down into some very simple and understandable concepts, shall we? Now, let's take an example of a broadly diversified portfolio. I'll put one of them on the screen. These are some of my favorite ETFs and index funds. And as you can see, this particular portfolio has 72% assets in equities and 8% in alternatives, 18% in bonds, and 2% in cash. So it's overall around an 80-20 portfolio. Most of it is in the US, 24%, which is about 30% of the equities are in the international. You have some REITs, you have some core bonds, you also have some tax-exempt bonds, some municipal bonds in there. And then you have some cash, which are ultra short-term treasury ETFs or money market funds. Now, let's talk about the 4 different tax treatments that any of your investments can go through. The highest level of taxes that you might have to pay is actually your regular income tax level. Now, you have to pay a regular income tax rate on the dividends or bond yields of these particular asset classes. So these are the most tax inefficient assets in your portfolio. Now, for an extreme example would be somebody living in California with a very high income, and the tax rate on a bond yield for this particular person could be as high as 52%. Now, the second type of tax treatment is called short-term capital gains tax. Now, capital gains tax is of 2 different types. Depending on if you're holding an investment less than 1 year, you'll be paying short-term capital gains. If you're holding any investment more than 1 year, you'd be paying the long-term capital gains. Now, it's much more preferable to pay the long-term capital gains rather than the short-term, and you'll see why. Now, the short-term rate is exactly the same as your regular income tax rate. Now, any mutual fund or any ETF that you sell or any individual stock that you buy and sell within 1 year, you'll have to pay regular income tax rate on this. Now, any ETF or mutual fund that you hold more than 1 year, which is for buy and hold type investment, you'd pay a much more preferable tax rate. Now, this particular tax rate is called the long-term capital gains rate. Now, this is usually around 15 to 20% depending on your tax bracket, and you may have something called the NIIT surcharge, which is about 3.8% depending on your income level. Although you can see the maximum rate you'll pay here is around 23.8%, which is less than half of the maximum rate you would pay as a regular income tax. Now, the most preferable tax treatment you can have is tax deferred or tax free. Now, what do I mean by that? Any money that you would put in a pre-tax bucket, something like an IRA or a traditional 401k or a 403b, these assets, you would not pay any tax on at the time of contribution. And as long as the assets stay in these buckets until retirement, until the time of RMD, which is required minimum distributions, hit you in your 70s, you really don't have to touch these assets and they'll grow completely tax-free. Now, some type of assets are completely tax-free once you have made the investment. The example is a Roth type investment. Any money that you've already put in a Roth IRA or a Roth 401k account, you will never ever pay tax on it, even in your 70s and 80s. And even your heirs can actually inherit this Roth bucket and they will never have to pay any taxes on it. That is an example of tax-free bucket, which is the best bucket to be in from a tax treatment purpose. Now, one other type of investment is called a municipal bond. If you buy a municipal bond from your own state, so if you live in California, you buy a California municipal bond, or you're a New York resident, you get a New York municipal bond, or let's say you live in Texas and there are no state taxes, and you buy any municipal bond, for example, they are free of federal income taxes, and they're also free from state income taxes if you buy state-specific ones. Now, let's talk about tax inefficient assets. The more taxes you would have to pay, the more tax inefficient the investment is. So anytime if you have to pay a regular income tax in case of bonds or REITs, which are very dividend heavy, or any high dividend paying stocks. Now, any investment which is more short-term capital gains tax heavy would also be tax inefficient. So for example, an active mutual fund, which is really buying and selling all the time to try to beat the underlying index, they'd often buy and sell the same investment within less than 1 year and generate a short-term capital gains, and the tax treatment is no different than something like a bond or a dividend. Now let's take an example of a few tax-efficient assets. So on top of the list is really any kind of ETFs. So ETFs are exchange-traded funds, and in general, compared to any mutual funds, an ETF is just structured more tax efficiently and creates overall less capital gains tax in general. Now, a broad-based ETF would be the most tax inefficient. For example, a total US stock market ETF like VTI would be the most tax efficient ETF because it really isn't buying and selling anything. Whatever is publicly listed is just always there. There is no turnover to say in a VTI ETF, in a total stock market ETF. Same exact thing for the international side. So if you have a total international stock market ETF like VXUS, it would be the most tax efficient thing that you can hold on the international equity side. And as we already discussed, municipal bonds are tax-free and therefore they are very tax efficient. Now, the tax efficient assets are best placed in a taxable account, like your taxable brokerage account. And the more tax inefficient the asset is, it's best to put them in a 401k or a Roth IRA or any kind of tax advantaged account. Now, I have a whole separate video discussing what are ETFs, what are index funds, and what are mutual funds. If you're interested, I'll attach that video right here. Now let's talk about the most optimal asset location in the three different tax buckets: pre-tax, Roth, and taxable. Now let's take my original portfolio with all the different asset classes in it and divide them into these three different tax buckets. And what's the most efficient way to do so? The example is right here. Now, first of all, let's talk about the taxable bucket. If you have to hold anything in a taxable brokerage account, I would hold a broad-based ETF like VTI and VXUS because these are the most tax-efficient assets there are. Now, if you really need to hold bonds in your taxable bucket, which again, I would rather have you hold bonds in your tax-advantaged buckets, but if you really have to hold them in the taxable bucket, you could consider holding a municipal bond. Now, if you are in a very high tax bracket and your taxable bucket is really, really large, you will probably be forced to hold some amount of bonds in your taxable bucket as well, and that's totally fine. Now, let's talk about bonds. Now, the best place for bonds is in a tax advantage account. Now, there's two different types of buckets within the tax advantage. There are two options. There's pre-tax and then there's Roth. Now, bonds are not going to be the most high growth asset in the long run, and that's why I would probably put it in a pre-tax account like traditional 401k or an IRA bucket. Now, the highest growth assets that you have in your portfolio are probably best placed in a Roth bucket, like a small cap value ETF or an international small cap value ETF. And now, there is a very important concept that you have to consider here is the order of retirement spending. Now, when you're spending income in retirement, the most optimal way and easiest way to understand this, you would spend the most tax inefficient asset first, and you would spend the most tax efficient asset the last. So the most tax inefficient bucket is the taxable bucket, of course. So in retirement, you'll spend that bucket down first. The second bucket is the pre-tax bucket. And the last bucket you will ever spend from would be the Roth bucket, because that's completely tax-free. And a lot of retirees might want to just leave it alone and leave those investments to grow forever. And maybe their heirs might inherit them. And that would be completely tax-free. So considering that fact, the highest growth assets should be placed in a Roth bucket, and something like dividend paying stocks like SCHD you could consider in a pre-tax bucket. I wouldn't put SCHD in a taxable bucket, but SCHD would do really well in a pre-tax bucket. Now, optional is something like an actively managed mutual fund is also placed. Something like VZICX, which I really like for international investing, is best placed in a tax advantage bucket like a Roth or a pre-tax. Now you have options here. You could place it really anywhere because this is a high growth asset but relatively tax inefficient. You have the option here to place it in a pre-tax or a Roth bucket. It really doesn't matter. But I would absolutely recommend against holding an actively managed mutual fund in a taxable portfolio. That's a horrible idea. And I've reviewed a lot of portfolios in which people hold high cost actively managed mutual funds in their taxable portfolios. The YouTube analytics tell me that a lot of you viewers are not actually my subscribers right now. If you would like to support my channel, please hit that subscribe button and like and share my video. Now let's talk about cash and emergency fund. Now you want your emergency fund accessible, and the taxable bucket, something like a high yield savings account or something like ultra short-term treasury bonds or money market funds within a taxable brokerage account, would be the most accessible way to keep your emergency fund. And I know this is not very tax efficient, but this is just a good idea, because you don't want to put your emergency fund in a 401k or Roth IRA and not have the ability to access it emergently. Now I know there are some exceptions in which you can access your 401ks and Roth IRAs in case of emergencies, but that's just a hassle and some additional step that you have to think about every time there is an emergency. And when you urgently need your money, it's just the best idea from a convenience sake to keep it accessible in a taxable account. Now, some of you might notice that the individual tax buckets are not representing a broadly diversified balanced portfolio, and that's completely fine. Now, this is a bit of an advanced strategy, and if you have significant amount of assets and you do have multiple different tax buckets in your portfolio, tax efficiency and asset location will help prevent overall tax burden and the tax drag which you will pay during your lifetime. So I would take a zoomed out view of your overall portfolio and add all the accounts up in total. Maybe you can use an Excel sheet to aggregate your portfolio and evaluate your total asset allocation. I know rebalancing will be a little bit more challenging because you have different ETFs and different mutual funds and different types of accounts, but this is the most tax efficient way to do it. Now, when it comes time for your annual rebalancing, I know there will be a few extra steps, but nothing a well-maintained spreadsheet can take care of. Asset location is an amazing concept to learn more about and actually very easy to implement. Now, if you learned something useful today, please like and share my video and subscribe to my channel. Thank you for watching. Money Matters MD, over and out. This is for educational purposes only and not financial advice.